Dish TV now after everything has gone through. Raj Mehta is with us, fund manager at Parak Financial Services, PPFAS. Raj, great to have you with us here. Thank you very much. And congratulations. I guess you guys celebrated Founders Days recently. Congratulations to you and the entire team there. You guys have been, of course, doing a fantastic job, trailblazing returns. So investors are happy. And the question I think a lot of people are asking is, how does one continue to maintain those returns after the tremendous rally that we've had? Or should we expect a period of slightly more subpar returns? What's your sense? Not just for you, but as an industry.
Thank you so much, Prashant, for having me, and thank you for those kind words. Yeah, definitely we are going into a period where the return expectations should be tempered, given the stellar returns that we have seen in the last 2 or 3 years. The returns going forward would not be of the same scale or anywhere near to that. So definitely the return expectations should be tempered, and going ahead as the inflation comes down, the obviously the nominal returns should also come down. So we have seen nominal returns for Nifty over a longer period of time to be around 12-13%, whereas the last 2 or 3 returns have been 20% plus. So we need to be mindful of that.
Okay, all right. Hi, Raj. Good afternoon. Good to see you in. Raj, just looking at your portfolio construct, the last sheet that I have that I've managed to find for the month of January, and you'll have rejigged the portfolio a little bit. So I wanted to ask you on 2 stocks. I believe EID Parry has been added to the list, if you could confirm that. And also ITC, you all were in early, but the stock has gone through a bit of a phase of underperformance. You'll have added further on that one?
Yes. So coming first to EID Parry, yes, we have added to the stock in both our equity schemes. The reason being that it's a holding company for Coromandel International, and it has a holding company discount. So given that the valuations that it was trading at, it made sense to add it to our portfolios. And coming to ITC, yes, we entered around COVID time, around 200 levels or even less than that. And we didn't add it for a good 2 or 3 years. But given that it has gone through some time correction and now some price correction as well, now it's started to enter into attractive valuation, and hence we have started adding again to ITC.
Okay, so that's a view on ITC. Raj, what is the view you are taking on domestic IT now? I mean, we all know about your US holdings that you still have, but what about local IT firms? If I remember correctly, I think you had HCL Tech in the portfolio, 1 or 2 mid-caps as well. So what's the sense now?
Yeah, so we have HCL Tech and Infosys to some extent in our FlexiCap fund, and in our tax-saver fund, we also hold Wipro as well as TCS. So the call there is that large cap IT names are better placed than the mid cap IT names, given the valuations that some of these mid caps are trading at. But at the same time, we feel that demand is very stable, and with the new technologies coming in, these IT services will keep catering to the enterprise clients that they have, and longer term trend of Indian companies catering to the global companies will continue for a longer period of time. The only question is the growth expectations that one has, and the valuations. So right now, large cap IT names are more in the reasonable zone. I would not say they are attractive, but they are reasonably placed. And mid cap IT, we feel that they are overvalued, and hence we don't have any mid cap IT names in our portfolio.
What about auto? Auto has been in the fast lane for the last 2 years. How long do you think this upcycle is going to last? And what about two-wheelers, where the growth has just started picking up over the last couple of months? Which segment would you prefer?
We went through a phase from 2018 to 2023 where we didn't see any volume growth for most of these auto companies, be it two-wheelers or four-wheelers. It was only about 6 months back that we started seeing some volume growth in most of these companies. And at the same time, with the raw material prices depressing, the margins have mean reverted to some extent for most of these companies. We prefer four-wheeler space over two-wheeler space, given that there is too much competition in the two-wheeler space, and electrification of two-wheelers and three-wheelers is happening at a more rapid pace than the four-wheelers. So we are right now positioned more in four-wheeler space, and we have Balkrishna Industries on the off-highway tire space. So these are the two auto positions that we have in the portfolio.
Okay, all right. Raj, just a request you to hold on to the thought. We have some comments coming in from Ajay Singh, the CMD of SpiceJet. He's saying Busy Bee Airways Private Limited and them, they have submitted a joint bid for Go First. The stock as it is was up close to 8%, and post this information that's coming in there, the stock has moved high. I think it's up now 10.5%. So keep an eye out on that one. And on the flip side, I'll be interested to see what happens to Interglobe, because post the shutdown of Go First, we did see that Interglobe Aviation did gain quite a bit. So now you have some more competition that's creeping in. Let's see what goes on that front. So I'll be interested to keep an eye on Interglobe. It's been a rank outperformer, the leader by a mile, but let's see whether or not there is some bit of a knee-jerk reaction on that one. For the time being, not really. Raj, I wanted to come back to you. A couple of other notable changes in your fund. I think NMDC Steel, where you all were in very, very early, you'll have reduced a little bit out there. But I think banks deserve a more important part. And as of now, I think 20% of your total portfolio is towards banks. You could correct me if I'm wrong, but I think most of them or all of them are private sector banks. What about the PSU banks? What's the view?
So yes, we have had about 20% position in the banking space for a long time now. It's just that we have, instead of adding more to Axis Bank, we have started adding Kotak Mahindra Bank about 3 months back. We don't have any PSU banks in the portfolio. Our opinion is that PSU banks over a longer period of time will cede market share to the private banks, and hence private banks are better placed than the PSUs. Also, PSUs have seen a good recovery because of the good credit quality that we have seen across the banks in the last couple of years. But we know that it's cyclical, and we are not too sure about the lending practices at most of these PSU banks. So we prefer private banks over PSU banks. PSU banks may be short-term trades here and there, but over a longer period of time, we prefer private banks over PSU banks.
Okay. By the way, I just want to go back to that SpiceJet story for a bit. The interesting aspect is that this move seems to be by Mr. Ajay Singh in his personal capacity, along with a different entity, a different airline entity that that is being spoken of. This doesn't seem to be happening or routed through SpiceJet itself, where there are anyway concerns about liquidity. Remember, just a couple of days back, our colleague Madiha had done the story on delay in some salary payments, delay in some other kind of outstanding dues as well, by at least a couple of days by SpiceJet. So it seems that Busy Bee Airways and Mr. Ajay Singh separate from SpiceJet, are going to be looking at this potential bid for Go First. Raj, I don't know. I know you have no aviation stocks at all. But just comment on this. I think this is something that a lot of people in the market grapple with, this huge surge in travel and commerce and the need to spend. Apart from hotels, is there any other way of playing it? Because obviously airline stocks have not been the biggest wealth creators, and we don't have too many to choose from actually in the listed space in any case.
That's correct. There are not too many ways to play that. The only other play could be other discretionary goods like consumer durables or autos or something like that. But yeah, we have seen, as we have seen K-shaped recovery in the economy, we have seen the top 20% of the population spending a lot of money, and hence we have seen a lot of demand in most of these discretionary names, be it travel, hotels, or even consumer durables and autos. So definitely we are seeing some pickup, but whether this demand pickup will be sustainable over a longer period of not, it's questionable. We feel that this is a short-term revival, given that there was a 2-year period where people did not spend too much. But yeah, it's a short-term revival, and we don't see it sustain over a longer period of time.
Okay, Raj, we'll leave it there. Thank you very much for joining us. It's a pleasure having you with us here. And thanks indeed for being with us on CNBC TV18. Well, 150 points higher is what we have on the index at 22,056. We'll take a quick commercial break here. We'll come back and we'll get you a quick check on what dealing rooms are saying. D Street Chatter with Nimesh coming up. And of course, after that, a short-term trading idea. Stay with us.